I am really interested in the next 45 minutes in talking with you about a real interesting case study in financial stability. I don't know how many of you have actually heard of the tri-party repo market. Show of hands. Oh, OK, good. And I'm assuming most of you know what a repo transaction is. This market actually turned out to be an interesting source of risk transmission during the recent financial crisis. So it wasn't really where problems started, but it was definitely where problems manifested and spread from participant to participant and market to market. And I think it's a really interesting example of how process shapes practice. So what I'd like to talk to you about today is really how the settlement process in this market actually gave rise to systemic risk in ways that weren't really apparent to most people until the 2008 experience. So the agenda is, first of all, what is a tri-party repo? Just a quick refresher for those of you who did not raise your hand. What systemic risks surfaced in this market in 2008? And then I'd like to talk a little bit about how the reform effort is attempting to mitigate those risks and the challenges that remain. So as many of you probably already know, a repo is essentially a borrowing of cash against a pledge of securities. The reason it's called a repo is that these transactions are structured as a sale and a repurchase of the security. Repo, short for repurchase. And typically, the loan is made against over-collateralization. So the borrower will take cash and provide some additional collateral beyond the value of the cash that's being borrowed. And that over-collateralization or haircut is really intended to protect the lender from fluctuations in the value of the collateral, as well as any fluctuations in value that might occur should the borrower default and the lender had to go out and recoup the loan by selling the collateral. Now, some repos are bilateral, where the lender basically takes on the job of managing the collateral that's pledged to it by the borrower. That includes daily valuation of collateral, ideally daily. I don't think there's a market now with there's not daily valuation. That was not true recently, until recently. To take additional margin whenever the value of the securities that's pledged falls below that desired over-collateralization amount. And also ensure that the borrower is only pledging to its securities that it's actually willing to take. And there are typically, contractual arrangements that govern all of these things. So what is a tri-party repo? Well, it's a repo with three parties. So in addition to the borrower and the lender, you also have a tri-party agent, typically a bank. In the US, it's a clearing bank. We have two of them. And that tri-party agent is actually hired to perform all of the collateral management tasks that I've just listed. Now, we don't actually have good information in the US right now on the overall repo market. We have very good information on tri-party repo because we have access to the information that the two clearing banks that clear all of those transactions have. We do not yet, although we're working to get better information on bilateral repo. But we do know anecdotally that in the US, a large share of repo activity does occur through this tri-party repo market. Who uses the tri-party repo market? Well, on the borrower side, it's a pretty small group of firms, actually surprisingly small when you think that this market is currently $1.9 trillion in size. It's basically 65 broker-dealers. These are firms that have an inventory of securities for their own account, may also be managing securities for prime brokerage customers, and they need financing for these securities, and so that's what they use the tri-party repo market for. It's a relatively low-cost way for them to finance because it provides a mechanism to access many, many lenders. And it's fairly liquid. On the lender side, much more diverse picture. The number varies over time, but we think that currently about 3,000 or so investors are active in this market on any given day. And these investors are, of course, seeking a safe, liquid way to invest cash, usually for a fairly short term. It tends to be shorter term transactions in the tri-party repo market than you would find in the bilateral market, where you see a lot of much longer repo transactions. And a particular appeal of the tri-party repo market for lenders is that they can actually outsource the collateral management to a third party, because many firms don't actually have or wish to develop the capacity to manage that collateral that's being pledged to them internally. So there's a range of firms that invest in this market: mutual funds, asset managers, securities lenders that take cash collateral from beneficial owners of securities and need to lend it out, municipalities, even some foreign central bank reserves managers, a wide range of parties that lend cash in this market. The positions that people have are very big. The largest dealers are currently borrowing nearly $200 billion a day, and that was actually as high as $450 billion plus per firm per day in 2008. Lenders also very large positions. The largest ones are lending in excess of 100 billion per day. So for some of the firms in this market, I mean, it's a pretty concentrated market, as you can see, and some of these firms have massive exposures to each other in this market. We have two tri-party clearing banks, JP Morgan Chase and Bank of New York Mellon, and that's been the case for some years now. So just to give you a sense of the trend in tri-party repo market size, we actually were not collecting data on this before the crisis, but we did begin to collect it in April of 2008. And as you can see, at that point, it was up to about 2.8 trillion. It's since declined, although, again, you can see in recent months, with the exception of January, it's started to trend up very, very slightly again. So it's a substantial market, nearly 2 trillion currently. And this just gives you a sense of how collateral that's financed in this market has shifted since the crisis. So again, we didn't have a lot of observation points for the detail on collateral during the crisis period, but we did collect some data in July of 2008. I think that's the first time we collected the collateral data. Basically, the blue shades of the pie are government-backed securities. The red shades of the pie are various types of private obligations. And you can see that there's been a real shift since the crisis toward government securities, but still a fairly substantial portion of collateral, I think about 14% right now, is private obligations that are financed in this market. So why does the New York Fed care about tri-party repo reform? I think we care about it from a number of angles. First, we supervise the clearing banks, and I think Jim is going to talk to you about supervision later today. But we supervise those institutions, and we're responsible to ensure that they're acting in a safe and sound manner. And it's particularly important because an institution like a clearing bank is obviously not just processing tri-party repo transactions, but it's doing a lot of other payment activities that are really integral to the US financial markets. So very, very important to ensure their safety and soundness. Additionally, we have a responsibility for payment system risk and making sure that payment systems operating in a bank in particular, also our own payment systems that we operate, such as FedWire, are operating in a safe and sound manner. We, I think, have always been responsible to some extent, but have a newly clarified responsibility since the crisis for financial stability of the US financial system in general. And since this is a systemically important market and the clearing banks are systemically important institutions, and indeed there are probably a few of the dealers that are also systemically important in this market, we also care about it from that standpoint. We, of course, also, as you heard yesterday, I'm sure, operate in the tri-party repo market to conduct our monetary policy operations in more normal environments, and haven't been doing it as much lately. But that is typically, historically, kind of the core of how we conduct monetary policy on behalf of the FOMC. And then if something goes wrong in the tri-party repo market, we are also, of course, the ones, as Joao just described, that will be looked to as a lender of last resort to backstop any liquidity problems in the market. So we have interest from a range of perspectives. I wanted to talk a little bit now about how the tri-party repo market was actually functioning back in early 2008. There have been some positive changes in this process, which you can learn all about if you go to our website. But back in March 2008, the way that this market worked was that at 8:30 in the morning, every morning, the clearing bank unwound or reversed all of the trades, the tri-party repo trades that had been on overnight. So it returned cash to the lender's clearing bank account and securities to the borrower's clearing bank account. And this was true even if the trade was a 1-week or 2-week or 1-month trade. Even term trades were essentially treated as a string of overnight transactions. So every day, cash and securities were changing hands in the morning, and then in the evening at 6:30, the new trades were settled, or ongoing trades were resettled to put cash back to the borrower and securities back to the lender. So that meant that there was a 10-hour period every single day where the two clearing banks were providing financing for all of the dealers' books in this market, the entire market. Why is that? It's because the lenders' funding would not settle until 6:30. These dealers still have securities during the day, and they still need to finance them. So a natural evolution of practice was that the clearing bank would provide the financing. So the dealer would borrow intraday from the clearing bank to finance its securities. And the clearing bank would lend on a secured basis. It has a lien on the securities that are in the dealer's account. Interestingly, and I think this is something that a lot of lenders may not have been completely clear on in 2008, is that to the extent that lenders kept their cash at the clearing bank awaiting the settlement in the evening of their new trades, they actually had an unsecured exposure to the clearing bank. So you begin to see this web of exposures that these firms have to each other. Then at 6:30 at night, every night, the clearing bank would complete settlement of the day's trades or ongoing trades that had been unwound in the morning, moving cash back from the lender's account to the borrower's account and securities in the other direction. So what's wrong with this picture? The tri-party agent bank is essentially functioning as a creditor, as a principal, for 10 hours of the business day. And this turned out to be a real source of risk in this market when things started to get difficult in early 2008. So there's a lot of fragility inherent in this institutional arrangement. Clearing banks were making large loans to dealers against collateral on an uncommitted basis. That's really important. They were not actually subject to a capital charge because the lines that they were extending were not committed. So in other words, there was an option the clearing bank had to extend or extend the credit on any given day. And they were, as I noted, financing the entire market for 10 hours a day. So basically, 2 clearing banks in April 2008 funding $2.8 trillion. So that's a lot of funding relative to the capital of those institutions. Dealers were exposed to rollover risk on the entire book every day. So even though they might have thought and did enter into some term transactions as well as overnight transactions, essentially everything is unwinding every morning. Now, there's a contractual agreement for a term trade. If things go bad, though, and a lender becomes concerned about a dealer's credit quality, do you think that they're always going to stick around and observe that 1 week? Maybe not. That daily unwind really creates an opportunity every day for the lender to rethink, do I really want to be in this trade anymore? The lenders had very large unsecured intraday exposures to the clearing bank. And I think it seemed as though the assumption that people were making was, well, it's safe. The clearing bank is always going to be there to unwind these trades. They're an agent. They're going to match trades. They're going to clear. I'll always get my cash back. And if there's a problem, it's unwinding tomorrow morning, and I'll just take my money and run. So there were kind of these interesting assumptions being made based on the way that the process was structured. And market functioning really was vulnerable to events that disproved these assumptions. So there were really kind of 3 bad assumptions I'd like to go through. One is that the clearing bank is an agent. We see that that was really not the case. There was nothing technically requiring a clearing bank to unwind on any given day. Even though I don't think people, again, really connected with that fact. People tended to view it as more of a committed line. It was not committed. The second bad assumption, the durability of secured funding. So, I think in most secured funding markets, it's probably pretty reasonable to assume that people look to the collateral, and this is the third risk, as a source of protection against a problem with the counterparty. But in this market, that actually turned out not to be the case for some actors. And again, the collateral also, for other reasons, turned out not always to be the protection people thought it was against risk. So bad assumption number 1. Clearing bank, obviously, as we've just said, was not a true agent, but was a creditor, in fact. And so it had the incentive, when concerned about a troubled dealer, instead of doing what's right for the system and continuing to clear trades and unwind and rewind repos, now it has its own exposure to worry about. So now it has the incentive not to unwind and to keep the cash, or to keep the collateral. And so a lesson of, well, several lessons that we learned from this experience is that dealers probably can't count on perpetual access in this setup to clearing bank credit. Lenders can't always count on getting their cash back. They may actually be getting collateral back, and they should be planning for that. Another lesson was that the clearing bank settlement process may not actually be continuous. If the clearing bank is exposed to a large dealer, it can actually be destabilized if there's a problem with the dealer. If it has a large exposure, it can then be destabilized, and that can have consequences not only for other dealers using the clearing bank in the funding market, but also beyond the tri-party repo market. Okay, a second bad assumption, tri-party repo runs are unlikely. That turned out to be a bad assumption. Some lenders will, in fact, run from a troubled dealer, even if the dealer is pledging top quality collateral to them. And that seems pretty inconsistent with the behavior you would expect in a secured lending market. But I think we saw that some lenders were essentially acting as unsecured lenders. One example of this is during the week of March 10th, 2008. Some lenders, and you can actually read about this in, I think it's the FCIC report. If you haven't read that, that's very, very interesting to read the chapters on the repo market. Some lenders would not lend to Bear Stearns even against treasuries, even in a flight to quality environment where treasuries were actually rising because everybody was leaving risky assets and flocking to treasuries. So that's really quite a statement about how lenders were viewing this type of exposure. Some lenders, it's also important to note, particularly money market mutual funds, securities lending agents, can also themselves be subject to runs. So even if they have the intention to continue to lend to a dealer, if they're facing a run for whatever reason, concern about exposure to an asset class or a specific institution or even a clearing bank, they may have the need to generate liquidity, to pull out from lending and perhaps even to sell assets. Just a couple of examples. So I always think of this kind of the twice daily handoff that was happening of exposure between the clearing bank and the lender and the clearing bank and the lender. It's kind of like that game of hot potato you played as a kid. But it really kind of created that dynamic where at the first sign of trouble in a dealer, two parties have the incentive each to get out first. And that can actually serve to accelerate the run dynamics. And not only is the run risk there, but the structure of the settlement infrastructure is actually probably working to accelerate that impulse when it arises. Lenders could also run from a troubled clearing bank. And that would be very, very problematic in that if they ran away from a clearing bank about concerns about that clearing bank's health, that means that any dealer relying on that clearing bank, because dealers typically do rely either on one or the other clearing bank for repo, they would no longer have access to funding. And that could prompt a wave of dealer failures that would destabilize markets well beyond tri-party repo. And of course would result in a big break of the flow in credit that could in turn have really adverse consequences for economic activity. This is just an interesting picture from a paper that my colleagues did, which I think can be found on our website. Copeland, Martin, and Walker back in 2010 did some really interesting work on repo markets and specifically looked at the behavior of tri-party repo as opposed to bilateral repo markets. And this is just a great picture to show kind of what a run looks like. So you see, even before the actual bankruptcy event, I think that's probably about a week. I mean, people started to get concerned about Lehman. There had been concerns for a while, but people really started to get concerned, and you see how quickly that asset book just drops. People are pulling funding, Lehman is deleveraging, and you can see, it happened in all asset classes. It wasn't just the riskier assets that experienced a pullback. There's a very sharp drop-off, a very quick one in government securities as well. So when a run happens, it's fast, it's furious. It's kind of equal opportunity in terms of asset classes. And that's just the kind of thing that we're really looking to structure the market to avoid in the future. OK, one third bad assumption, collateral is a risk mitigant. This is a pretty good assumption usually. I mean, this is kind of the principle of secured lending, is that secured funding, you have kind of two risk mitigants. You do your credit analysis, you determine how comfortable you are with your counterparty. Hopefully you're comfortable, but if you get uncomfortable, you still have that collateral to look to recoup your losses if the counterparty fails. And as I noted a minute ago, we actually saw in the crisis episode, some tri-party lenders really acted like unsecured lenders in the market. I think there are a lot of interesting reasons for this. One is what I mentioned a minute ago about the fact that some lenders are actually subject to runs themselves, so they may face pressure to generate liquidity. In addition, a couple of other institutional factors that are worth noting. Money market mutual fund regulations actually require right now funds to look at the counterparty rather than the collateral in classifying the risk exposure. Additionally, we've learned that some lenders actually do accept collateral as, in repo that they cannot actually hold under the terms of their investment policy. So it may not be a suitable investment, but they may still take it as collateral. So there's a disconnect that then results, in the event of a problem, if they are left with collateral from a defaulted dealer that they can't hold, what are they going to do? They probably have a strong incentive to sell that. And for that reason, another risk that we're very worried about in this market, should a dealer default, there's a very significant risk of fire sales of collateral because of the composition of the investor base in this market. In addition, and I'm sure you guys have probably talked about this in yesterday's session or earlier today, we also know well that some high-quality liquid assets funded in tri-party repo turned out not to be so high quality or so liquid. Certainly, AAA-rated mortgage-related assets, structured assets, became illiquid when people realized that the quality of those assets is not what it was purported to be. And of course, other types, particularly of assets without a government backing, also became illiquid as broader financial market stress began and liquidity in funding markets dried up. So in these various ways, the market's design gave rise to instability in a stress event. Settlement infrastructure's design, in this case, allowed some bad assumptions to arise and persist. Dealers underestimated their exposure to rollover risk because of the nature of the unwind process. Lenders underestimated their exposure to dealer credit risk because of their certainty about the clearing bank as a source of repayment for them. Dealers underestimated the risk that a clearing bank could actually put them out of business pretty much immediately. If a clearing bank decides not to unwind your repos, you're pretty much done. And then the clearing banks underestimated the possibility of a lender run that leaves them exposed to a troubled dealer as well. And as we noted earlier, a clearing bank that's destabilized then creates a lot of other problems, not just for the dealers it's serving in tri-party repo, but for the many other payment activities that it's undertaking for broader financial markets in the US. So all of these assumptions seem to have impeded proper risk recognition and pricing. And while tri-party repo didn't cause the crisis, again, it was really an important locus when the stress arose. This was a very important locus of risk transmission among firms and to other markets. I suspect you have already probably spent some time talking about the Federal Reserve's policy response in the crisis. There were some key pieces of that policy response that pertain to efforts to backstop this market and an effort to avoid a complete breakdown in tri-party repo. The key one there was really the primary dealer credit facility. This was established in March 2008 as a backstop for the repo market, really to try to preserve some confidence of lenders in the market to allow it to continue to function, to avoid a refusal to unwind that would put other dealers out of business, and also to avoid a run by lenders. We also expanded that program a couple of times in September of 2008, following the developments at Lehman and then the ensuing market stress. Again, to really try to avoid a complete shutdown of this systemically important market. We facilitated the acquisition of Bear Stearns by JP Chase in March through June 2008 in order to avoid fire sales of collateral that would have followed Bear Stearns' default. So these are all actions we took. Really, I think we didn't have a lot of other options. We didn't have other authority. Other people didn't have this authority. We were the ones that had this authority. Dodd-Frank, of course, has subsequently limited some of these powers that we have in terms of emergency lending. And so I think the goal that we're left with is really, let's try to reform this market so that we can avoid a need for central bank intervention in the future. We may not completely avoid it, but I think we can do a lot to reduce the likelihood that it occurs. So let me just talk a little bit about the reform effort that's underway now. How many of you have actually heard about tri-party repo reform or are aware that this is, I see a few hands. Okay, great. Well, the effort actually began in 2009. I think at that point, there was the feeling here that things had improved enough in the markets that it was really time to think about how can we restructure some of these processes to be safer in the future. And so in September of 2009, the New York Fed and board officials also met with senior industry leaders to discuss the risks in the market and how the industry could take steps to improve and strengthen the security and stability of market practice. And following that, we established an industry task force to work on these issues. And in May 2010, the New York Fed published a white paper that identified 3 critical risks that we felt needed to be addressed by reform. The first of these was the fact that the market was heavily reliant on intraday credit provided by 2 clearing banks. The second was the fact that the settlement process had really impeded proper risk management, liquidity risk management for the dealers in particular, and credit risk management for lenders specifically. and that there was really no way to insure against a destabilizing fire sale of assets in the event of a dealer's default on its tri-party repo obligations. So during 2010 and 2011 and through into February of last year, we had an industry task force that met, did actually a lot of good work diagnosing the issues, agreeing on the types of changes that were needed to improve stability and safety of the way that the market functioned. However, I think it's hard for any voluntary group to come up with concrete actions and hold each other accountable for those. I mean, everybody coming to an industry group can only control what their own firm does. So early last year, we decided it was probably time to take what the industry had done and to try to help to provide some incentives, further incentives through the supervisory process to get firms to live up to the commitments that they had made. So that's what we are in that mode now. The current reform efforts, we're very confident that they will address the first of these risks. I personally think they're going to go a long way toward also addressing the second of these risks. But I should be clear, they're not going to address the third risk. So that is going to be a challenge that remains. We'll come back to that at the end of the deck. This is a 7-point vision for reform that came out of the Industry Task Force's final report last February. And it basically, I'm not going to go through every bullet. I know you guys can kind of look through it. But it shows you the aspects of the process and practice that industry participants felt really needed to be changed to remove some of these sources of systemic risk from the institutional arrangements that were in play in March 2008. And you'll see, in different ways, changes can serve to reduce the demand for intraday credit, to reduce the supply of intraday credit, to speed settlement finality so that you have a more disciplined and tighter process at the end of the day, enhance transparency, and just in general makes more transparent for participants the risks that they're actually taking as they engage in these transactions. So we are actually at the Fed now managing to that industry roadmap, and we are using our supervisory tools to ensure that there's progress that's being made in a timely fashion against those. And in fact, if you go to our website, I have a link at the very end of the slide deck, but we have a nice web page now on our website. It also has links to, I believe, the schedules of both clearing banks for the plans that they have that they're pursuing to actually execute these changes. So there's more information on that if you're interested. So what we think reform will accomplish, as I noted a minute ago, I think it really will go a long way to reduce the supply of intraday credit. One goal that we have is that clearing banks will not provide credit to dealers in excess of 10% of their notional repo books. And in fact, clearing banks may, in the end, choose to provide even less than that, but certainly no more than 10%. Whereas, until a couple of months ago, they were providing 100%. Clearing banks also will be required at the conclusion of the reform efforts to provide intraday credit only on a pre-committed basis. So no more of this uncommitted stuff. They're going to be providing committed credit. They will be subject to a capital charge for that. And we believe that that shift will really incent them to better ration and price the credit that they're providing and to really think about the risk that they're taking with capital. We also expect that the changes will reduce demand for intraday credit in a couple of ways. Non-maturing trades will no longer unwind. This is actually already true at JPMorgan Chase. As of November, they stopped unwinding all but the maturing trades, which reduced their exposure by about 40%. And that change will also occur later this year at Bank of New York Mellon. In addition, both clearing banks are working on re-engineering their settlement process so that going forward, the gap between the unwind and rewind of maturing and new trades will essentially happen simultaneously, because really that gap between unwind and rewind is where the credit need intraday was arising. So that's another way that they're looking to eliminate that gap, and that will reduce demand for credit by dealers. We think that by getting the clearing bank substantially out of the intraday credit business, some frictional level of intraday credit will continue to be needed just to facilitate substitution of securities without getting into too technical details. But we think that that frictional level of credit is relatively small, certainly no more than 10%. That's actually where the 10% came from. That was the task force's forecast of what level of frictional credit would be needed. So essentially, they really are going to become an agent and not a principal in these transactions. The changes also will mean that from now on, or when reform is completed, lenders will be exposed 24/7 to the dealer that they're lending to until the maturity date. So that's a big improvement. You know, there's no more of this kind of back and forth dynamic. The exposure that you have is the exposure that you have until maturity. That means the term trades really will be true term trades now. They won't be a string of overnight trades. We think that it'll be much less likely that a troubled dealer can destabilize a clearing bank because the clearing bank will no longer have that massive exposure to the dealers. And conversely, that it's less likely that a clearing bank will be able to put a troubled dealer out of business or even a healthy dealer out of business by denying credit. Because again, they'll be much less reliant on the clearing bank for that. All of these changes taken together, we're pretty confident will result in much better risk recognition and pricing. And that's really what we want. This is an important market. We want to continue to foster this market's existence, but we want the activity to be occurring at the right price for the risk that's being taken. This is a graph from our website that just gives you a sense of the estimated trajectory based on our estimates of what we know of the clearing bank's plans that are public for the pace of risk reduction. And when I say risk reduction, I'm specifically referring to reduction of reliance on intraday credit. So as you can see, they've already gotten to about 80% from their original level of 100%, and they're working towards that 10%. We expect that to be realized by the end of next year. A remaining challenge, I noted earlier that reform will not address the third of the risk issues that we had identified and continue to be concerned about, which is fire sales. As I've noted multiple times during this talk today, many of the lenders in this market have a high propensity to run at the first sign of trouble at a dealer. Many of these lenders have strong incentives to dump assets on the market rather than hold them and sell them gradually over time. They might not have sufficient capital to bear the mark-to-market losses that would be involved in holding for a period and disposing more gradually. They may need to generate liquidity due to shareholder redemptions or calls from beneficial owners for a return of cash collateral if they're a securities lender. They might need to sell quickly to avoid accumulating losses. They will kind of want to be the first out the door before prices really drop and the subsequent sellers really are hit with much larger mark-to-market losses. A fire sale of assets, I don't know if this is something you've already talked about earlier today, but it's highly destabilizing, particularly in the sizes that we're talking in this market. Massive sales would push prices downward. All holders of the asset would then experience mark-to-market losses. That would erode capital, which in turn prompts deleveraging to make up for that erosion of capital, and it's just this vicious circle. So it's really a problem that has yet to find a solution. It's something that we're thinking a lot about in the Federal Reserve System, but I think it's probably the most difficult of the three risk issues that we've identified. So that's really all I wanted to cover. I hope that this has been an interesting example of how process shapes practice and how much risk can reside in the plumbing of the financial system. I think it's a risk that we've been sensitive to for a long time, but I think even we learned a great deal about this issue from the recent crisis experience. And hopefully we'll have a very good success story to talk about in a couple of years. Thanks.